The Portland Trail Blazers just sold for $4.25 billion. That number shouldn't make sense on paper. We are talking about a small market franchise with zero recent playoff success, a lottery-bound roster, and a bottom-tier revenue profile. Yet this sale just shattered the expectations for what a distressed NBA asset is worth, effectively resetting the market for every sports team in North America. Most people look at the box score and see a failing team, but when you look at the balance sheet, you see a masterclass in estate management. This wasn't about basketball. This was about a 25-year legal strategy executed by a trust that treats sports teams like distressed assets. If you watched our breakdown on the Seahawks ownership limbo, you know the Paul Allen Trust plays the long game. They didn't sell when the market was hot, they sold when the legal handcuffs came off. We are breaking down the specific legal loophole that saved the estate nearly $700 million, the CEO scorecard that justifies this record-breaking price, and why this deal just set a $10 billion floor for the Seattle Seahawks. To understand why this price tag is so shocking, you have to look at the CEO scorecard. When you value a normal business, you look at cash flow, growth metrics, and executive performance. When you value an NBA franchise in 2025, those traditional rules evaporate. We need to compare the Blazers against recent transactions to see just how absurd this valuation really is. Look at the Phoenix Suns. They sold for $4 billion recently. The Suns had higher revenue, a roster loaded with superstars like Kevin Durant and Devin Booker, and a recent finals appearance. Now look at the Blazers. They ranked 24th in the league in revenue at just $315 million. In the annual survey of NBA executives, the Blazers front office ranked 26th. You have a bottom third revenue generator and a bottom third management team, yet the Allen estate secured a higher sale price than the Suns. This creates the mediocrity paradox. The Blazers commanded a revenue multiple of 13.5x. For context, the Minnesota Timberwolves, a team with a similar market size and better recent on-court performance, sold for just $1.5 billion a few years ago. That is a massive gap. The Blazers punched way above their weight class, effectively selling a fixer-upper for the price of a luxury mansion. The estate leveraged the scarcity premium to drive this number up. There are only 30 NBA teams and they rarely hit the open market. Even though the team's operational performance was stagnant, the asset class itself is so restricted that billionaires are forced to pay a premium just to get a seat at the table. Critics will point to the market size. Portland is a small media market compared to Los Angeles or New York, but the sale price proves that market size is becoming irrelevant in modern sports valuations. The Blazers were priced as a global asset. The buyer isn't paying for the local TV deal in Oregon, they are paying for the international streaming rights and the global brand equity of the NBA. The estate knew this. They understood that the operational failures of the last 5 years, the losing seasons, the draft bust, the coaching turnover, didn't actually damage the asset's core value. They could afford to let the team drift into mediocrity because the rising tide of NBA valuations would lift the boat anyway. The price creates the headline, but the timing of the sale created the profit. The $4.25 billion figure is impressive, but the real story is the money the estate didn't lose. To understand the profit margin here, you have to dig into the fiscal poison pill buried in the original public funding agreements for Paul Allen's sports assets. This is where the legal strategy becomes fascinating. We are talking about Referendum 48 and the specific bond documents filed with the Washington State Public Stadium Authority. These bonds were issued in May 1999 to fund the stadiums and infrastructure that Allen's teams rely on. Buried in the fine print was a 25-year clawback provision. Here is the math that dictated the entire timeline. The agreement stipulated that if the teams were sold within 25 years of the bonds being issued, the state was entitled to a non-participatory interest payment. That is legal speak for a 10% tax on the gross sale price. If the Allen estate had sold the Blazers or the Seahawks in 2023, or even early 2024, they would have been forced to write a check for 10% of the total volume to the state. On this Blazers deal alone, that would have been a $425 million penalty. When you combine that with the potential sale of the Seahawks, the total bill would have exceeded $700 million. This explains the hold strategy we have seen for the last 5 years. The media and fans spent years criticizing Jody Allen, the trustee, for being indecisive or emotionally attached to the teams. They accused the estate of lacking direction. In reality, Jody Allen wasn't being indecisive. She was being legally precise. She had a fiduciary duty to the charitable beneficiaries of the trust to maximize the financial return. Selling early and triggering a $425 million penalty would have been a violation of that duty. She had to wait out the clock. The timeline is undeniable. The bonds were issued in May 1999. Paul Allen passed away in 2018. The clawback provision expired in May 2024. Almost immediately after that date passed, the wheels started turning for this sale. The estate successfully navigated the lockup period, ensuring that every single dollar of that $4.25 billion goes to the trust rather than the government. It turns out that inactivity was the most profitable move they could make. They saved the money on the exit, but they still needed a specific type of buyer to pay the premium. They saved the money on the exit, but they needed a specific type of buyer to pay the premium. Enter Tom Dundon. If you don't follow the NHL, you might not know the name, but you need to understand his money. Dundon isn't your typical tech oligarch looking for a vanity project. He is a subprime lending tycoon who built his fortune with Santander Consumer USA. He specializes in distressed assets and high-risk yield. He looks at a balance sheet like the Trailblazers. Bloated expenses, stagnant revenue, underutilized real estate. And he doesn't see a problem. He sees an efficiency gap he can exploit. We know exactly what he's going to do in Portland because we watched him execute the Hurricanes playbook. When Dundon bought the Carolina Hurricanes, they were an NHL doormat with empty seats and bad financials. He turned them into a profitable juggernaut using a strategy that blends data analytics with yield management. It starts with the Lenovo Center model. Dundon doesn't just want to sell tickets. He wants to capture the real estate value around the venue. In Carolina, he pushed for mixed-use development to create 365-day revenue streams that aren't dependent on game days. He views the arena as a shopping mall that happens to host hockey games, and he is going to apply that exact pressure to the Rose Quarter in Portland. Then there is the ticket yield. Before Dundon, Carolina struggled to give tickets away. Under his watch, they hit 117 consecutive sellouts. He didn't do this by just lowering prices. He used dynamic pricing models to push capacity to over 100%. He treats every seat like a commodity on the stock market. If demand spikes, the price moves instantly. He creates artificial scarcity to drive urgency. The Allen estate found the perfect buyer because Dundon views the Blazers not as a sports team, but as an under-monetized asset with massive upside and ticket yield. Finally, look at the payroll analytics. Dundon runs a Moneyball operation. He hired Eric Tulsky, a nanotechnologist turned data analyst, to run the front office. They maximize wins per dollar spent. He isn't going to pay for past performance. He pays for future production. The Allen estate managed to sell a fixer-upper franchise at a premium price because they found the one guy in sports business who prefers a fixer-upper over a turnkey mansion. If a fixer-upper NBA team goes for $425 billion, what happens when the estate sells the crown jewel? The Blazers sale effectively sets the minimum floor valuation for the upcoming Seattle Seahawks sale. You just have to run the base case math. If a small market NBA team with limited media reach trades at 13.5 times revenue, the Seahawks are operating in a different stratosphere. With NFL media rights printing money and a global Super Bowl brand, the Seahawks comfortably clear $9 billion as a starting bid. But the real variable is the Super Bowl LX multiplier. The upcoming Super Bowl in Seattle is the final variable to push the price toward a bold case of $10 billion. The liquidity crisis becomes the only ceiling here. At a $10 billion price point, the buyer pool shrinks to fewer than 10 individuals globally, names like Bezos or Ellison. The auction dynamics change entirely when only 3 people on Earth can actually afford the opening bid. The Blazers sale proves that in high-stakes estate management, patience is a legitimate revenue strategy that outperforms operational excellence. The win wasn't on the court, it was in the fine print of a 1999 bond agreement and a 2025 sales contract. For aspiring executives, the lesson is to always audit the public funding clawbacks before initiating a sale process. If you want to see who actually buys the Seahawks for $10 billion, subscribe now because that breakdown is coming next.